Okay, welcome to all of you here and to all those that are attending this seminar via web all throughout the world. My name is Andrea Roncoroni. I'm professor of finance at ESSEC Business School, and this is the first of a series of seminars that we are going to run all throughout this year, 2015 and 2016 as well. And they're all devoted to the area of energy and commodity finance. Indeed, this series of seminar is just one of a number of actions that we are currently pursuing at the SEC within the newborn Energy and Commodity Finance Research Center. So just a quick snapshot of this kind of activities. We have a new track within our finance concentration. We have a PhD course, and in the last year and a half we have been publishing Argo Review, which is a quarterly magazine devoted to banking and to energy and commodity markets. So it's a pleasure for me to be here with you and with all those that are attending this seminar through the web. Let me first of all thank our sponsor, that is LABEX MMEDII. It's a very strange French acronym, identifying a research fund that is granted by the French government to a pool of universities, including the heading institution that is the University of Cergy, and the SEC Business School is part of these funds. So next I'm going to thank CERESEC, which is a center of research at the SEC Business School, and Energisk SAS, which is a company devoting to advisory for corporates, and in particular corporates that have to deal with energy and commodity price risk. Let me, before I'm going to present our guest speaker today, let me introduce you with Patricia Charletti, who represents the LABEX fund at ESSEC Business School. Patricia would like to make a short introduction to the LABEX.
Yeah, I will be very short. So you might not all be familiar with the LABEX. Actually, it's a consortium of research centers, and ESSEC is part of it, with different research centers in various areas. Again, maybe it's a strange name, like the French acronyms, typical names. M stands for mathematics. There are two I's, one which stands for interaction, the last I from uncertainty, uncertainty. So your topic, commodity, energy, finance, and risk, is really part of the heart of the LABEX interests. So the LABEX, which I represent here, is very happy to support this series of webinars and all the project, which is much larger, which has been put forth by Andrea and Francis, which includes PhD courses and many other events to come. So thanks a lot for being here, and thanks for you.
Thank you, Patricia. Okay, so the center is currently headed by Professor Francis de Klerk, a colleague of mine, and myself. And let me welcome Hilary Thiel. Thanks for coming. Hilary Thiel is principal at Premier Capital Management. That is a trading company based in Chicago, in the US. And besides her professional activity in the commodity business, Hilary has a very long list of publications in the area of empirical commodity finance. She is also author of Commodity Investing. That is a benchmark book published in the prestigious series of Risk books, where for the first time they made an issue on considering the commodities as an independent asset class. So thanks for coming, Hilary. And here is your presentation, Structural Position in Oil Futures Contracts. What are the useful indicators? Before starting, just 30 seconds for a technical information. For those who are attending this seminar through the web, you may write down your question on the right-hand side of your browser. In order to be allowed to do that, you should log in Gmail and Google+. Once you are inside Google+, you're going to see on the right-hand side of your screen a bar, and in that bar you can write down your questions. So we're going to make a selection of these questions, and by the end of today's presentation, Hilary will answer to a few of them. Thanks, Hilary. Please.
Thank you, Andrea. It's automatic.
Pardon? There. Okay, good.
Both. Okay, thank you for that delightful introduction, Andrea, and congratulations on your new book. And okay, so bonjour, mesdames et messieurs. Je suis enchantée d'être ici. And good afternoon. I'm grateful to be invited to speak today at the ESSEC Business School. So thank you, Professor de Klerk. Thank you, Professor Oncaroni. And so, as Andrea noted, I'm going to discuss what the useful indicators are for deciding upon whether to enter into long-term positions in oil futures contracts. All right, excellent. So, in answering the question, that's the title of the presentation, I'm going to cover the following 5 considerations. First, I'll discuss the case for structural positions in crude oil futures contracts. Secondly, I'll discuss 2 useful fundamental indicators for avoiding crash risk. Third, I will give a brief overview on financial asset diversification for downside hedging of oil price risk. Fourth, I'll discuss the usefulness of an indicator based on U.S. Commodity Futures Trading Commission data. Fifth, I'll provide my conclusion on how to approach position taking in the crude oil futures markets. And finally, I'll briefly discuss the recent market turmoil and prospects for the future. And one thing that you'll note is my presentation will be heavily empirically based, but obviously there's an underlying assumption that the past states of the world that you can infer from historical data are going to be the case going forward. Okay, so why have asset allocation models typically included structural positions in crude oil futures contracts? Well, the reason is portfolio diversification. In order for a commodity index to not only hedge bond investments against inflation, but also do effectively for equity investments, then the index needs to have a concentration in the portfolio, in the petroleum complex. And this is according to a Journal of Portfolio Management article. So accordingly, the main commodity indices tend to be heavily weighted in the portfolio, the main commodity indices tend to be heavily weighted in the petroleum complex. Okay, so a nuanced feature of all futures markets, including in crude oil, is how important, at least over the long run, the structural shape of the crude oil futures contracts, or the crude oil futures curve, has been for driving returns. Now, I suppose I should clarify terminology. When a near-month contract is trading at a discount to more distant contracts, we say the shape of the curve is in contango. And so this is shown in the graph on the left for the first NYMEX WTI crude oil contracts, and this is a graph from March 2011. And accordingly, in the first 4 contracts, you can see that the prompt month price is trading at a discount to further month contracts, and basically that gives the return for storing crude oil over the first 4 months of this graph. And then on the right-hand side, I show the curve structure for Brent crude oil, which at the time was entirely trading in, quote, backwardation, and that's where the front month price is trading at a premium to the deferred delivery contract, or the deferred delivery contracts. Okay, so slide 8 illustrates how over sufficiently long time frames an individual futures market's returns have tended to be related to the commodity's structural futures curve shape. Now, there's a lot of this is a great graph. I always look for graphical representations of a huge amount of data so that I can immediately understand relationships. And so this is averaged over a long time period, 1983 to 2004. And my next slide will have a more recent time frame. And so, I mean, one issue is that in order for this sort of structure to appear, you need to average over a very long time frame. This is not going to show up in sort of month-to-month data. But over very long time frames, the contracts that tended to be most backwardated had the highest level of returns. And the y-axis shows annualized total returns, and so that includes the returns from buying and holding futures contracts, rolling them, and then also the returns from collateral. And okay, so you see these are controlling contracts. Now, the reason I think this is important to show is that it is one reasonably reliable statistical property is that spot commodity prices mean revert. For Chicago futures, Chicago futures traders would say high prices cure high prices and low prices cure low prices. So how can there be any return from commodity futures contracts? And that is basically there's these highly nuanced features. Once you look over very long time frames, a spot commodity price can mean revert, but what's left is sort of this incremental curve effect. If you're continuously buying forward contracts at a discount to the spot price, that return effect adds up over very long time frames. And I actually co-wrote a paper where I wanted to use as long historical data as possible to figure out when this curve effect becomes, you get a high R squared for that determining returns. And the issue, say, with the oil markets is the earliest contract that started trading is 1978, and that was heating oil. With WTI crude oil, that was 1983. So if this effect only shows up over long holding periods, that's not a whole lot of data. And so I used the grain markets. The issue in terms of having a long contiguous data set, once I went through the Chicago Board of Trade statistical annuals using microfiche, is that in the 1940s, because of World War II, there were price controls. So there's a gap in freely traded prices. So the longest contiguous data set that I had was in the grain market since 1949. And so in that paper, what we found was that what the structural shape of the futures curve was only showed up as a strong driver of return at 5-year holding periods. And this is analogous to the equity markets, where in order to have the dividend yield have a higher squared in explaining returns, you need a 5-year holding period. Okay, so in deciding on structural positions of futures contracts, and I'm going to be focusing on the oil markets, structural, by the very way that I define the presentation, structural, I mean, over the long run. So therefore, it's appropriate to focus on curve shape. Okay, this is an updated graph from 1999 to 2014, where again, over this very long holding period, if you average out the structural curve shape against returns, you also get the linear relationship, and concentrated in the sort of the upper right-hand quadrant, again, is the oil markets. And then if anybody was an index provider, you'd also notice that nickel and copper tend to be structurally backwardated, and also have high long returns despite mean reversion. Okay, so what I just showed was that the average returns for a futures contract were related to the average level of backwardation for a contract. And the top performing contracts over long enough holding periods were in the petroleum complex, which had the highest average levels of backwardation historically, could, deciding upon entering a structural position in the crude oil markets, depend on what the curve shape itself is. In other words, does this provide a good on-off toggle in terms of investing or trading and holding the positions for a considerable length of time? So the answer is yes. So if you only held WTI futures contracts from 1987 onwards, there's a substantial return difference if you're only in if the contract's backwardated versus if it's in contango. Passively holding the oil futures contracts led to returns of 6.2% over T-bills. Using curve shape as a toggle, the returns became 12.8% over T-bills. Now again, another long-term chart. How about more recently? And so we can look at the Brent futures contract through most of 2014. If you got out of any structural position of crude oil, just examining the front-to-back spread to see whether it was trading at a discount or a premium, again, a substantial return difference. As a futures trader, given how volatile commodity markets are, I try to rely on objective measures rather than every day trying to decide what to do, and this provides one indicator. Now, I'm also going to cover what the fundamental reason is that this is a great indicator, and I'll be covering that later in this seminar. Okay. If you accept that a crude oil-based investment is an advisable diversifying asset for a balanced portfolio of stocks and bonds, is there a way to potentially avoid the crash risk of a crude oil holding? Now, that would probably be a very sort of topical question. And an inspiration for answering this question based on relatively simple fundamental quantitative indicators, I thought came from a 2010 IMF paper. And so I'll just paraphrase from this paper. The author discussed the currency carry strategy, where an investor takes a short position in a currency with a low interest rate and a long position in a currency with a high interest rate. And that strategy's returns over a long enough time frame has had a high Sharpe ratio, but the returns are negatively skewed, implying, and you know this as a trader, that those kind of trades are subject to crash risk. So what the IMF researcher then described was a fundamental valuation metric for analyzing currency pairs. And that author's fundamental metric was based on 1, terms of trade, and 2, the relative GDP per capita of the two countries of a currency pair. Okay, so we had a fundamental metric for what the fundamental value of a currency pair was. Next, this researcher looked into what would happen to the performance of a passive carry strategy, but you exited that strategy when the exchange rate overvalue or undervaluation relative to the fundamental metric exceeded a threshold level. So basically, whether whatever z-score, or if there's a British audience, z-score exceeded that level, whether it's a z-score representing 1 or 2 standard deviations, then you would exit the carry strategy. And so what the researcher found was this hybrid strategy had a relatively high Sharpe ratio, but was less negatively skewed, and for some currency pairs, positively skewed, compared to the negatively skewed carry strategy. And in practice, investors that invest in global macro and CTAs want a positively skewed return profile, and in essence are willing to accept lower returns as long as there's a positively skewed return profile. Okay, so can we apply that insight to holdings of crude oil? Because when it just, at least from sort of, a mile up looking from the clouds at why you would hold, say, oil futures contracts, it's very much a carry argument, because up front I said that commodities tend to mean revert. So a passive strategy is basically, over a long enough time frame, a carry strategy. So could it apply that you have a handful, 2 maximum? Because you don't want to curve fit, too much, but logical fundamental valuation metrics. So if you exceed those levels, okay, fine, you exit the strategy. And what happens to returns? What happens to max drawdown? What happens to the skewness profile? Okay, that's what I'm going to cover. Right. Okay, so I'll give the answer, and then I'll give some of the empirical backing. I'd argue that the relevant fundamental metrics for crude oil are 1, the spare capacity situation, and 2, the inventory situation. Right, but first, what's the present definition of spare capacity? The U.S. Energy Information Administration has defined spare capacity as the volume of production that can be brought on stream within 30 days and sustained for at least 90 days. And from the U.S. Energy Information Administration website from last year, they noted that OPEC spare capacity has provided an indicator of the world oil market's ability to respond to potential crises that reduce oil supplies. Now, I was very careful with my wording, and I was saying this is what the present definition of oil spare capacity. It may be in the future, though, the definition of effective spare capacity wouldn't just be Saudi Arabia and other Gulf oil producers, but may also include shale oil in the U.S. So in the presentation, I try to be, so that this presentation might be long-lived, I try to talk about spare capacity rather than just saying OPEC spare capacity. Okay, so to motivate why the spare capacity situation is so important to the behavior of crude oil prices, I'll review the circumstances of 2008. And again, I'll use several graphs they thought were really great in just distilling the point. Okay, so we know from the events of 2008 what happens to the oil excess capacity cushion, or actually what happens to the price of oil when the oil excess capacity cushion becomes quite small. In July 2008, the role of the spot price of oil was arguably to find a level that would bring about sufficient demand destruction so as to increase spare capacity, after which the spot price of oil spectacularly dropped. Now, that sounds like crash risk. The spring got pushed out too wide and then snapped back. And so I'm going to use 2 graphs, one from researchers at the Federal Reserve Bank of Dallas and one from researchers at the Commodity Futures Trading Commission, to just quickly illustrate this point. All right, so slide 17 excerpts from the Federal Reserve Bank of Dallas paper. The red line shows WTI prices, and the blue line shows excess capacity levels. It shows how once you got to this pinch point level, which is right around 1 million barrels per day, the oil price exploded. So what would be why is that significant? Well, the amount of commercially available global inventories is, not great. And so historically, the markets relied on spare capacity, i.e. Oil that could be brought on quickly in case of any geopolitical or weather crisis. So what the price has told me is that 1 million barrels per day is considered a pinch point because the price of crude oil responded by exploding. Okay, and here's another graph, and there's a number of caveats with this graph, but I'll stick to the main points. Okay, so the x-axis is spare capacity, y-axis is WTI prices. I like this graph. I only saw it in this one Commodity Futures Trading Commission paper. The lead researcher later went on to the International Energy Agency, but this is analogous to the typical economics of storage graph, where the price of a commodity becomes exponentially high when there are low enough inventories. Again, there are a number of caveats to explain this graph, but that's the trade-off in using visual representations of information to illustrate a point. Okay, so thinking back to that IMF currency paper, one exits the currency carry strategy if the fundamental valuation of a currency pair surpasses a threshold level. So it would seem that one candidate for a fundamental variable to monitor in the case of crude oil is spare capacity. So arguably an investor should consider toggling out of an oil futures position when there's an indication of low spare capacity in order to avoid the potential of an eventual crash risk. And so how would the returns from a structural position in oil futures contracts been affected if one used this fundamental variable? Well, the answer is the negatively skewed returns become positively skewed. Right. Okay. So on slide 20, over the period February 1999 through January 2015, if one unconditionally bought and rolled Brent futures contracts, the returns were 1.2% per month and were negatively skewed. In this case, I excluded the returns from collateral. Given the period of very low interest rates that we're in, it's tricky analyzing returns from holding futures contracts because they typically include the collateral returns, and in the past you'd have an extra 5 or 6% to add. So it's probably in order for return data to be useful to investors, I need to just focus on the futures only returns and not assume any returns from collateral, at least for the time being. Okay, so notice negative skewness. Right. How about if you were only invested in Brent futures contracts when the spare capacity was greater than 1.8 million barrels per day, and voila, the returns become positively skewed. Analogous to the IMF currency paper. Okay. Now, there's another advantage. Some investors and traders may be concerned about how their investment strategy is perceived. So in 2008, when the price of oil was spiking, it was, I won't speak for other countries, but it was a huge political issue in the United States. So when oil prices were spiking in 2008, the chart on the right shows how often a variant of the word speculator speculative, appeared in a U.S. Senate hearing. And so what the graph illustrates is the spike in that interest in that word in the Senate report versus other fundamental explanations of the oil price. So for some investors and traders, it may be advantageous to avoid crude oil futures exposure when there's minimal global oil spare capacity. If that investor or trader is concerned about their strategy being referred to as predatory. So, I mean, okay, well, if you're not invested when the oil's spiking, I mean, you couldn't be blamed for sort of, the disastrous economic consequences that happen when oil prices spike. And not only that, you have a superior statistical distribution in your returns. Okay. So in review, when oil spare capacity has reached pinch point levels, oil prices have spiked higher, creating demand destruction, followed by the price of oil consequently crashing. Now, what I found interesting, I always like reading analysts and then seeing how their predictions, panned out, because then in the future you sort of know who to listen to in terms of who has insight. And a Goldman Sachs analyst had predicted precisely the scenario of what happened back in 2005. And he just used the logic of what happens when spare capacity gets to pinch point levels. So I thought this was pretty cool. This is a graph from 2005. 3 years beforehand, predicted what would happen. Now, anybody that follows sort of economics of storage and the sort of the banana-shaped price patterns that can happen with commodities, maybe this would not have been too much of a stretch to predict. But at least publicly, this is the only one that I'm aware of that predicted this so presciently, including even time frame. Okay. So an additional consideration in avoiding the downside risk of holding oil futures contracts is during times of ample supply. So this would be the second toggle to use. Okay, so in the now what I previously presented concerned spare capacity. There are a lot of nuances to that because there's sort of official spare capacity, there's effective spare capacity. There sometimes can be differences between the Energy Information Administration and the International Energy Agency in figures. So there is nuances even using that as a trigger or a toggle. So what I just decided to do is say, okay, this is using Energy Information Administration data, and conceptually it makes sense to me. But there may be nuances if you compare, say, what the IEA said at the time, or even comparing their respective data now. Okay, well, another issue with data, because I'm trying to use fundamental triggers, is that crude oil inventory data is either not timely or, in the case of global data, not reliably available. Now, provided that the United States on the margin is the entity that matters for crude oil, then okay, fine, use U.S. data. But when that is no longer the case, it's problematic using U.S. only data. So what I basically do is like, look, the curve shape very much makes sense as an indicator what the inventory data is. So my fundamental indicator for times of supply or not is the curve shape. You can read papers back to like 1948 from Holbrook Working discussing the curve shape as explaining the returns to storage. So when you're in contango, it makes sense to me that that's saying that there's surplus of inventories, even if you're not capable of counting every barrel globally. But I know this is one of my assumptions. Okay, so for example, there's plenty of representations of this. It's just that I happen to like this graph. It was from an IEA analyst who's now at BNP Paribas, and this illustrates when you're in times of backwardation, i.e. front-month trading and premium to back month, that you have relatively low inventories, and in this case, this is from 2003, and this is OECD North American inventories. Arguably, it was the beginning of China as being the dominant factor in the commodity cycle wasn't until 2004. So you're still sort of in a U.S.-centric world with the 2003 data. And then you see the front-to-back spreads in contango. But that's a time of relatively high inventories relative to trend. Okay. So this is using this price relationship variable is my fundamental metric. I mean, I'm using it to infer fundamentals. Also, I mean, there's some intuition. When I originally started futures trading quite a while ago, I thought, okay, I'm going to use fundamental data to as sort of create models of fundamental data to be able to predict price patterns. But what I always found was that price relationship variables or the magnitude of recent price changes were highly correlated to the fundamental data at the time, and the price relationship data always had a higher t-stat in sort of being able to predict things. And I thought, well, why is that the case? And then I thought, well, hang on. By the time I see fundamental data, it's relatively late. And any entity that is involved in the commodity markets is going to know the fundamental information way before me. I mean, they'll know, where the oil is in the ships that's eventually going to be delivered, etc. But they will express their views for the futures markets. Okay, so if I want a real-time snapshot of the largest players of the world, what their views are, I need to use the futures markets rather than wait for stale fundamental data to come out. Okay, hopefully that's not too much of a nuanced argument. Right. So, the IMF paper allowed sort of two factors for, giving a fundamental metric. So hopefully it's okay for me to use a second factor here, which is, only be in structural long-term crude oil positions if you have sufficient spare capacity and the front-to-back spread is in backwardation. And in this case, you reduce the maximum, the worst monthly result. And one of the interesting things, I mean, I figured this would be the case, but again, I love the graphical representation of, somewhat. I don't know if I'd say the data is complicated, but if I just look at numbers, I mean, it's like license plates, going by. It doesn't mean anything to me. So the conceptual representations mean everything to me. So I'm borrowing from this graphical representation, like the idea of it, the concept is from a Fung and Shea 1997 paper where they were describing the empirical characteristics of hedge fund strategies. And so what I did was, I took the sort of that hybrid strategy where you're passively in crude oil, except for these two toggles, and how does it perform across quartiles of Brent excess returns? Well, you see that unconditionally you're going to miss these, the whopper huge returns, but in return, you're avoiding these, essentially the crash risk. And so this type of strategy behaves as if it owned collars, which are long puts, long puts and short calls on crude oil. Now, why would I find it interesting to create a return profile like this? Well, clearly this is the type of return profile that investors want, because this is abstracting from a hedge fund return profile for states of the equity markets. That was from the Fund and Shame market paper. And let's think about this. Okay, if you're an ETF provider of passive index exposure, you know what fees you get. If you're a hedge fund provider based in equities, you know what those fees are. So to me, that means that people really, really, really like this return profile. So that's why I kind of put the strategy through that template. Actually, I watched a presentation from Professor Joelle Miff, and there's a flip side to this, because she took commodity markets, and if you did a screen on going long the most negatively skewed and short the most positively skewed, you actually earned excess returns, which made sense to me, because perhaps it could be the case that skewness is sort of a priced risk factor. Okay. i.e., so it's what's your objective function? Is it the highest possible geometric average returns, or is it creating a return profile that investors are willing to pay bonus or substantial fees for? Okay, so at this point, it may be the case that attendees would be willing to concede that the spare capacity and curve shape are useful for deciding upon structural holdings in crude oil futures contracts. But what about now? So for the time being, it looks like Saudi Arabia and other Gulf oil producers are no longer providing a free put to the marketplace in balancing the supply and demand situation. So let's look at, is there an analogy? And with some caveats, 1986 appears to be an analogy, and I quote here in slide 30 from a Brookings Institute paper on the 1986 market share strategy in the Gulf. So how would this strategy have performed? Now, according to EIA data, OPEC spare capacity is only 2 million barrels per day right now. In the mid-'80s, let's see now, according to an Oxford Institute of Energy Studies paper, in the mid-'80s, the OPEC spare capacity, specifically, let's see now, make sure, right. OPEC spare capacity in the mid-'80s was 10 million barrels a day. So the spare capacity figure, toggle would not be relevant in '86. But, okay, so it's only the curve shape, right. So if you passively held WTI contracts, you lost 25% in '86. If you only earn the returns conditional on backwardation, you lost 9%. So that held the line using the curve shape, not entirely. And in the next section of the presentation, I'll show that you need basically financial asset diversification. Okay, I'm just going to skip that and go right to financial asset diversification. Right, so how did the equity markets do in '86? They earned 13%. Now, granted, as my business partner would say, one data point does not a study make. But still, in scenario testing, you would want to see, given the analogies between now and '86, how financial diversification would have helped or not. Okay, so in a study using data from, let's make sure I get this accurate, from a 2008 Journal of Financial Economics paper, from data from '73 to 2003, they generally found across developed markets, on average, a decrease in 1 month's oil price indicated a higher stock market return the following month, and the impact of oil price changes on stock returns tended to be economically large. Now, there's a caveat on sort of the oil price and equity market. Again, there's sort of a states of the world thing. If the drop in oil price was due to supply, that's one state of the world. If it's due to a recession, an economic shock, there's a bifurcation on the effect of lower oil prices on the equity markets. Here I'm using data from HSBC, and again, so there are two things that I really like. One is great graphical representations and a lot of data, and the other is as long historical data as possible. And this HSBC report used data since 1876, and so they looked at if oil prices dropped by more than 30%, what happened to the equity markets. And in general, with some exceptions, the equities rose on average by 11%. But what's the caveat? If the drop in oil is due to an economic shock, then it's not that the equity markets are going to do well. And so, I mean, that's basically a deflationary scenario. So what does well in a deflationary scenario? Bonds. Okay, and so sure enough, we look at the global financial crisis, and the second half of 2008, bonds made 13.8%. Okay, so in terms of avoiding crash risk, it's basically the fundamental toggles, and then the judicious use of financial asset diversification. I have done a number of these asset allocation mixes, and of course, there's no free lunch. There's always a trade-off. When you're going for higher geometric average returns, you also notice, oh, well, actually, there can be a 3-year period where you underperform a 60-40 portfolio. And if your peer group, or you're measured against a 60-40, and there's a 3-year block that you underperform peer group, that can, and especially if you underperform for up to 5 years, that can lead to, well, not a whole lot of investors can sustain that many years of underperformance. So the caveat in going for higher geometric average returns by up to, say, 300% per year is also how many years you can tolerate underperforming a neutral allocation of a 60-40. Okay, so another thing, the title of the presentation was Useful Indicators. Another useful indicator comes from the CFTC Disaggregated Commitment of Trader Report data. And so this is, I reproduced this graph based on a report from JP Morgan analysts. And so what you can do is, so I downloaded the data. I could just go to the CFTC website, but it's so easy to use Bloomberg to just download data in the spreadsheet. That's what I do. So here in the sort of pink line, you see the positions in crude oil of swap dealers, which sort of stands in for commodity index positions, and managed money, and that kind of stands in for hedge funds and CTAs. And you can see in from July 2007 onwards, the positioning of basically index investors and CTAs was declining while oil was spiking. So when you notice that, you might think, gosh, what do they know that everybody else knows? And sort of dug into the fundamentals a bit more. And basically, the Baltic shipping indices were sort of spiking and coming off previous to the oil price spike. So you had a fundamental indicator that a huge source of global demand was declining. Okay. Right. So the main conclusion is, right, yes, fine on long-term positions of crude oil, but only do so when the futures markets require price risk-bearing services, and that kind of shows up in the curve shape. And obviously, when oil prices are spiking, the function of the market is not to increase long positions in the crude oil futures markets. Because of these macro factors, crude oil futures should be, rather than standalone, be part of a diversified portfolio. And this is one of the things that I said at the beginning. This is all based on historical data. So to the extent that there's changes in the state of the world not reflected in the historical data, then these results are correspondingly won't hold. And I'll briefly discuss the recent market turmoil. For oil markets to have the scale of moves that we have now are not unusual, whether it's peak to trough drawdowns or scales of or sizes of daily moves. Deutsche Bank put out a piece that the scale of moves that are happening now happen about every 5 to 10 years. So there probably would be historical comparisons that would be apt. A number of analysts have shown this. This one is based on Goldman Sachs research, where you can trace along the current oil price drop to what happened in 85, 86. And it's the analog. And then the interesting things here, this is end of March 86, which there's a kind of fundamental reason, because that's when really you have the refineries started coming on stream and using crude oil. Okay, and then again, if historical analogs are okay to look at, and this also logically makes sense, but if it's a the difference, there's a difference in the historical analog based on whether the oil price shock is supply-driven or a demand shock. And so the intention of slide 55 is to show how a supply-driven decline, which arguably is happening now, has historically kept prices lower for longer compared to when a decline is due to a demand shock. Okay, seasonals are huge in the commodity markets. And so this is just to point out, like, we are at a normal time of seasonal demand for crude oil due to refinery maintenance period. So I just illustrate that from based on a graph from Citigroup. And this is based on a graph from Pyro. And so you can see the normal seasonals, which is your during refinery maintenance period, you're going to have oil inventories building, and then as the refineries come back on stream, and if you look at U.S. and Europe, refineries don't fully come back on stream until May. And so you see what's going to happen with crude oil inventories. It's just normal seasonals, and that overlays with building up product, which is gasoline and heating oil inventories. So a consideration here is you have a surplus of supply and demand, and it's precisely happening during the weakest seasonal period for crude oil demand. So when people make timing predictions, they're basically looking at these normal seasonals in terms of what's going to happen with inventories and price. Oh, and a consideration is sort of tracking. Okay, so you have this much surplus supply and demand. It should last through the refinery maintenance period. You have however much storage capacity onshore. If you get to the so then there's a return for storage there. As you get to more difficult manners of storing, you need a greater return for storage. So you can have the long-term price of crude oil being near 70, but the spot price is has to go to whatever level provides a return for storage as you get to as you use up primary, secondary, tertiary storage. And the interesting thing in terms of empirical stuff is, so I would say, well, what's the normal price of crude oil? I'd look at the long-term graph of curve shape, and the forward price of crude's, I don't know, between 65 and 70. But you can also look at analyses of, okay, well, this is where supply and demand gets balanced, and this is where the marginal barrel is, and what does the price of crude need to be for that marginal barrel to be produced. And again, you get a 65 to 70. Yet another thing, I was reading two different commentaries that looked at European E&P companies and Asian E&P companies that had reserves. And so if you looked at how the market was pricing the companies, their stock price, and then you looked at the reserves, you saw the market was also implying a normal price of crude around $70 a barrel. Okay, but that doesn't mean that that's where the spot price is going to be when you have these accumulating inventories. Okay, so here's the last point. Right, so I had said that 86 is an analogy, and I only had mentioned one thing so far, and that was that in 86 you had like mid-80s, 10 million barrels of spare capacity per day. Now it's apparently just 2 million. Another difference is Chinese demand, and BCA research used an analogy graphically where they showed the post-2009 Chinese stockpiling when crude prices got crushed, and overlaid that behavior with what's happened since the end of 2014. So another factor that's different than 86 is the need for building up a Chinese strategic petroleum reserve. And so that's going to be a sort of a source of demand that did not exist in 86. Okay. So absent any, as you notice, I avoided talking about geopolitical shocks. I don't have an edge in predicting that. So those are important. And so that's why I heavily caveated when I'm saying this is according to historical data, what we can infer. But absent geopolitical shocks, one can one can get a very good idea when the spot price of crude will start recovering according to the seasonal refinery demands. And then you sort of count the number of days and months and quarters till you bring down the inventories, and Citigroup has done that. And on trend, the surplus inventories would not be used up till the end of 2016. So the tricky thing is you can have, say, starting end of July, a recovery in the spot price of oil, but if you're an investor in commodity futures contracts, you're still going to be paying away that negative carry. So total returns for commodity futures might not recover until end of 2016. Okay, thank you so much for your attention.
Okay, thank you, Hilary. Is there any questions? Please feel free. It's a unique opportunity to make a question. Join market.
Thank you, Hilary, for your very nice presentation. In your analysis of the influence of spare capacities of the oil price, would you take into account a lag effect according to the geographical localization of the spare capacity? Because when you are in the US, it's the same thing to have the spare capacity in Venezuela or the Middle East.
Well, what I was relying on there was the various statements that thus far the spare capacity's effectively been Saudi Arabia and other Gulf producers. So I did not take that into consideration. Now going forward, if it becomes the case, given the market share strategy that appears to be occurring now, then anything that I said spare capacity would have to include not just OPEC. There was an IMF paper from 2005 that referred to the OPEC spare capacity situation as essentially providing a free good to the marketplace. But that free put obviously no longer exists. Oh, the other thing was, let's see, Reuters just covered this. So this is why I find the spare capacity thing definitely interesting, because the Secretary General from OPEC in January pointed out that eventually oil could go back to 200. And you're thinking, now why did he say that? Well, the spare capacity is at like 2 million barrels. So once you got back to supply and demand being balanced, you still have this pinch point. And a Reuters article from last week pointed out that Saudi Arabia was actually working on increasing its spare capacity cushion now. I mean, the exact opposite of what's happening in North Dakota.
You mentioned about the importance of backwardation and contango as a factor. My question is, what about accelerators and brakes of backwardation and contango? Because these are perhaps those who tell you how to turn those stylized factor into trading prescriptions.
I'd say it's definitely something to test out. I mean, I guess I've got two answers. One is again with Fung and Shea. Okay, so they're amongst my favorite in how you do these empirical analyses. They looked at CTAs, and the strategies were all highly correlated. So what was the alpha when it seemed like they were getting exposure to risk factors? And that was timing. So if you've got like a superior timing algorithm, the market pays a lot for having that expertise. So maybe what you mentioned would work. The only thing for me is that I've found that maybe it's a bias, but out of sample, for the stuff that I've done, only the simplest stuff has worked out of sample. So that's why I basically stopped trying to do complicated algorithms, because they didn't work out of sample. But maybe that was just me.
Any other question? Please.
Basically during your presentation, you emphasize on some problem lack of on good data. So basically, my question is that why this so-called lack of good data happened, and what's the problem of this good data, these situations?
Well, my understanding is some countries regard commodity inventory data as a state secret. So different countries have different ideas on transparency.
So for example, some the storage and some the capacity about their oil stocks usually some nation level of some secret. Basically, some countries try to hide some data.
Right. So different countries have different ideas on the utility of transparency. So that's why, I mean, I'm a huge advocate of the futures markets, because I think that's the most transparent way to figure out fundamentals. It's all inferences from the price. That's where you get your transparency. And after the fact, if there was a price move that I couldn't explain, it was not that the markets were irrational. It's just that I didn't clearly have complete information in terms of what's going on in the world.
So just simply speaking, currently this in particular the oil market are not transparent.
Yeah. So I mean, the international. I remember in 2008, even the International Energy Agency, there was an essay in one of their oil reports decrying even Western governments not putting enough money into making sure their inventory data was accurate. So, I mean, there's two things. One is if a country doesn't think that transparency is in their best interest, and another is the countries that are okay with transparency but aren't giving the necessary funding to the statistical agencies in order to provide accurate data.
Right now we face both a demand shock and a supply shock too. So I suppose it's very different from your historical records.
Yes.
Does it affect strongly your findings?
Well, let's see. Yes, because to the extent that this is there's an extended demand shock, believing that the normal seasonals like 1986 will lead to the beginning of a spot price recovery in by end of the summer, I would be wrong. So that's why in my conclusion I heavily caveated things according to what you could infer from historical data. But one thing that you'll note is that I'm kind of letting the price data tell me. So if these markets are just in structural contango for an extended period of time, that would be the market telling me, oh gosh, this demand shock is very long-lived. That said, according to BCA research, the additional Chinese demand for private and government stockpiling could add up to 820,000 barrels per day. So that's also not in the that part of the 1986 scenario. Anyway, I sound like the two-handed economist on the one hand, on the other hand, but as a trader, I let the price signals tell me.
Thank you.
I hope to see you again in about 3-4 weeks, I guess, right? That's next seminar, and will be Ronald Huisman on electricity markets, presumably, because we haven't gotten the title yet. So you may just follow us through our website, that is energyandcommodityfinance.sec.edu. Thanks for coming.
Thank you.
And thanks to Hilary, of course.
If you need to drink some